The bank just agreed to lend enough money to buy a house. Curiously, it did not first locate a saver who had misplaced one. So when the mortgage is actually released, where does the money appear from?
First, one important correction. A mortgage can be approved before any spendable money exists. The decisive moment is when the bank actually advances the loan. And at that moment, it does not normally search its vault for one saver's matching deposit. That familiar story treats the bank like a warehouse. Money arrives from savers, waits politely on a shelf, then leaves with a borrower. Real bank lending is more interesting and much less physical.
The bank does not move a pile of money. It expands its balance sheet.
When the mortgage is advanced, two entries appear together. On the bank's asset side is the mortgage loan, the borrower's promise to repay. On the liability side is a new customer deposit, the bank's promise to provide spendable money. Your debt is an asset to the bank. Your deposit is a liability of the bank. Two promises appear, but only one of them can buy the house. The deposit is new. The obligation is equally real. So the bank has created money, but it has not created free wealth. The borrower receives purchasing power and a debt of the same size. The bank receives an income-producing asset and the risk that it may not be repaid.
Now the new deposit has a job. It must become the seller's money.
If buyer and seller use the same bank, the bank can simply reduce one customer's balance and increase the other's. Its deposit liability changes owner inside the same institution. But if the seller uses another bank, a second layer appears. The buyer's bank reduces the buyer's deposit. The seller's bank credits the seller. Beneath that customer payment, reserves move from the buyer's bank to the seller's bank to settle the obligation between them. The mortgage itself does not travel. It remains an asset of the original lender. Reserves still matter, just not in the way the old mechanical story suggests. Households and businesses spend commercial bank deposits. Banks settle with central bank reserves. The initial loan does not convert a fixed packet of reserves into a larger packet of customer money. But once deposits move, the bank must be able to meet payment outflows, obtain funding, and hold enough liquidity to keep its promises.
Which raises the obvious question. If a bank can create a deposit by making a loan, why not approve every borrower and add several comforting zeros?
Because creating a deposit is easy. Creating a good loan is not. The bank needs capital capable of absorbing losses. It needs liquidity and funding when deposits leave. It needs borrowers likely to repay and enough interest income to cover funding costs, staff, systems, expected defaults, and the capital tied up by the loan. Regulators impose capital and liquidity requirements. Policy rates change borrowing demand and the economics of lending. And there must be real customers who both want the loan and qualify for it. Banks can create deposit money. They cannot create capital, reliable borrowers, profitable loans, or unlimited payment capacity. The original creation can also run in reverse. When the borrower repays principal using a bank deposit, the bank reduces the outstanding mortgage asset and reduces the customer deposit liability. Less loan remains, and less bank-created deposit money remains in circulation. The principal payment reverses the original pair. Interest follows a different accounting path. It becomes bank income used to cover costs, losses, and profit. It does not cancel the loan principal pound for pound.
So where did the mortgage money come from? When the loan was advanced, the bank created a new deposit and a matching loan asset. The deposit could buy the house because people trust bank promises as money. But the house, the borrower's income, the bank's capital, and the years of repayment still had to be real. The vault was never the trick. The balance sheet was.